Hi there, everybody. Thanks very much for being here right on time today. And we'll get started with our presentation very shortly. This is Craig at Max Trading, and it's great to welcome so many traders into our room from all around the world. I see we have some traders new to Max and a few Max members here as well, and thanks to all of you for participating in the webinar today. Here at Max Trading, it is my privilege to work with men of integrity, men who are fine traders and who are also passionate about helping traders learn to trade more profitably. I believe you will sense this as you listen today. And whatever your trading goals may be, whether a more enjoyable job, working at home, financial freedom perhaps, helping friends and family, charitable contributions, all these things, we look forward to helping you achieve your goals. That's why we're here. I believe you'll be pleased to find an authentic trading education, one that provides a reliable method of trading, along with the flexibility to use the time frame of your choice and to trade whatever market you prefer. We'd like you to be fully informed today, so please don't hesitate to ask questions anytime. Just use the question window. We'll also have a question-answer session following our presentation, and we will stay as long as you have questions. Also in the question time, I'll give away 2 free Max courses as our door prizes for today, just to say thank you for attending. By the way, you must be present in the room at the time of the drawing, so please stick around, and I hope you're a winner. First up today is Eusebio, and he will give us an overview of the entire Max Trading methodology. Eusebio is a phenomenal trader, a skilled teacher, and there is no one better suited to introduce you to Max Trading. So thanks very much, Eusebio, for sharing part of your Saturday with us today, and would you please take the microphone?
Yes, sure, Craig. Thank you very much for this introduction. So welcome to every one of you to invest some of your time to be with us today, whatever it is, the morning, the afternoon, the evening, or perhaps even the night, depending where you are all over the world. Before making a presentation of what the Max is, allow me to make a very small introduction on who I am. So my name is Eusebio Nani. You have perhaps recognized my accent, which is not a native English or a native American accent. In fact, I speak instead the Globish instead of English. And I am a Belgian trader living half of my life in Belgium and half the other half in France mainly. And as a background, I am a full-time trader, especially in the Forex since 2000, so 16 years now. But I have had the pleasure to develop that passion for many more years, 30 years approximately, with an experience in many markets. I have started as many in the stock market, then the options market. I have tried also the futures market, and then I have found my passion in 2000 with the Forex market. And in the same time, I was a past software engineer in the IT industry. I was a service manager for an IT company, and I have worked in that company for 27 years. And the last 15 years of my profession in the IT industry, I have had the privilege to participate to many projects in some important banks in Europe, and this has given to me the opportunity to be in relationship with some traders in these banks, and from whom I have learned some ideas, some concepts. And what is fun is at that time when I was first talking with them, I think I did not really understood what they were explaining to me. And it's only this last year that I have begun to understand, in fact, how the big boys in the banks are really trading and moving the market. And so when we combine that knowledge with the concept of the Max, first of all, many of these behaviors are implemented implicitly in the Max, but you will understand that if you take the course. And so this is why the Max, as you will understand today, is a very powerful methodology. And so today I'm going to speak about the max trading system itself, what the max is not, and I will illustrate some of the concepts with some recent and past trades examples. And I will talk also a bit about the money management, because I consider the money management is also a very important aspect of any trading system. And so what I'm doing, I'm pushing on the wrong button, sorry. And I think I have perhaps screwed up the recording. Let me come back to the initial Zoom. And this is this row I must use. So the max trading system has been created years ago, many years ago, by late Dr. Jim Pruitt, known by his students as Tiger. Tiger, because of a strong temperament, being groomed by the tiger has always been an amazing experience, but it's not because Jim had a bad temperament. It was a strong temperament, but he wanted also his student to assimilate the max as fast as possible, because he knew his time was counted at that moment. I remember the first course with Jim at the very beginning of 2008, in March or February or March 2008, and then he passed away the next year in mid-2009. So the aim of Jim was to give his students and the traders a very powerful but also flexible and reliable trading method. And I like to use the term method and not system, because as I will explain later, the max is not based on fixed and rigid rules, but on rules which must be adjusted depending on the market conditions. And this is very important. This is what makes the max powerful, reliable, and flexible. And of course, it is a simple system based on simple concept, but it is not an easy system to use. There are a lot of details to assimilate, to understand, to apply correctly. And so there are two important keys which are important to become successful with the max: work and commitment. Mastering the max does not require just a few hours watching the videos or participating just one time to the course live. You will have to review the video, to practice and practice again. It can take several weeks, several months, several years to master the max, depending on how much time you can dedicate, depending how you are in your trading culture. And so this depends really on each one. And so this requires a lot of commitment, a strong commitment. If your only commitment is to make money, because after all, this is one of the objectives of trading, if your commitment is only to make money, you will fail. You will fail with any serious trading methodology. And so you need to have a stronger commitment to accept, to invest the necessary time to study, to practice, and then to be participating into the market. But there are also other keys or other skills which are necessary to become successful in trading, and especially with the max: discipline, patience, persistence, concentration, and confidence. Discipline is something which is common to many trading systems. But for the max, it means, because the max is based on concept and rules, we have to stick to them without never ever deviating from that. Patience, as I will explain later, the opportunity to open a trade and the situations to close a trade are based on setups. I will explain what I mean by setups later. And so this means that we need to have the patience, or enough patience, until the conditions for these setups are completely fulfilled. And it is only when the conditions are fulfilled then we can take an action. Persistence. Persistence is also a very important one. There is a lot of myth in trading, and one of them is considering that a trading system is a bad one after 2 or 3 losing trades in a row. This is completely ignoring the reality of trading. Do you know, for example, that if you have a trading system with an 80% winning rate, you can still face losing streaks, and I mean by losing streaks, losing trade in a row, made of 6 to 10 losing trades in a row. 6 to 10 losing trades in a row is much more than 3 losing trades in a row. And between 6 and 10, it's statistically normal. This is the average you will observe with an 80% winning rate. And so it is important to be persistent. And so you have to continue applying your concept and rules, whatever your losing streaks. And so this is why, also by the way, why the trade risk management and the money management are so important to survive these winning streaks without them hurting too much our account. So persistence is important. Concentration also. I have said that the max is made of a lot of details, and sometimes, in some circumstances, a small detail, when we neglect it, can make a big difference in a trade result. And then the confidence. The confidence is also a very important aspect, which is linked to the psychological or the psychology of trading, and it is a complex matter. And we consider that with the max, we have to build 3 levels of confidence. The first level of confidence is the confidence in the market itself. Does the market provide us with enough opportunities day after day after day? And just to be convinced of that, it's enough to scroll through charts on any pair, on any time frame, on any time period. And we can observe that the market provides regularly enough opportunities to trade. So we can have confidence in the market. Then the second level of confidence to build is in the trading system itself, in the max. And this is by making the effort through the commitment I have mentioned previously in order to understand, to assimilate the concept and the rules, and then to apply them correctly. Because this will show you that the max has the ability to catch not necessarily all the opportunities which appear in the market or the market provide us with, but to catch a large majority of them. And then the last level of confidence, which is perhaps the most important one, is in the trader himself, or herself. And so this comes only by practice, by practicing. And there are several ways to practice with the max. Of course, Chris will explain a little more later today, but just to make a quick explanation, by participating to the course actively, making all the homework which are assigned after each sessions, and participating to all the other coaching activity or practicing activity we have regularly, and we call them the scrolling parties we make each Saturday, for example, in order for each trader to be convinced that he or she applies the max correctly, so that he or she can have confidence in himself or herself. And so this is very important keys to develop over time, and this is also a reason why it takes time, in fact, and effort. And so that being said, what is the max? In fact, do you see my cursor on the screen? Do you see my cursor on the screen?
We do, Eusebio.
Okay, fine. So the max is in fact an acronym for 3 concepts. The M stands for momentum, the A stands for acceleration, and the X stands for exit. We want to open a trade, indeed, only when we see momentum in the price movement. And we want to see enough momentum, not too much momentum, and not too small momentum. The A stands for acceleration. Acceleration is linked to the way to increase the profit we can extract from a movement while the movement is unfolding. And to do that, we apply a scaling technique, a scaling and scale-out technique, by adding to the trade in order to build progressively a larger position. And of course, because we will progressively increase the position when the trend will unfold, it is very important to pay attention, to focus first of all on the trade risk management, on the risk associated with the position, because we need, it's an obligation to keep that risk under control. And then the X stands for exit. At some point along the trade, through the scale-out technique, we will have to close partially a small portion of the position, and at some point we will have to close the entire remaining open position. And so we will have 2 types of exit, as I will show on some chart, a momentum or minor exit, and then a final exit. And so essentially the max is a trend following method. Now we have, as I will explain later, 5 levels of the MAX Primer, the MAX Lite, the MAX Standard, then the MAX Advanced and the MAX ETF. Up to the MAX Standard, so the 3 first level of the MAX is indeed a trend following approach or method. With the MAX Advanced and the MAX ETF, we consider also trading the counter-trend movement. And so we can trade any type of movement, especially with the MAX ETF. And so, as I have said, we pay a very strict attention to the risk management and money management. And so we have very strong rules about that in order to force us to focus first of all on the trade risk and not on the profit we can extract from the trade. And so, as Craig has mentioned in his introduction, the MAX is applicable to any time frame, from the 1 minute time frame up to the monthly time frame, or even different time frames if you have other charting and trading platform than MetaTrader, to any market. And so the stock market, the option market necessarily, if you can trade stocks, you can trade options, the futures market, the commodities market, and then of course the currency market. So if it is important to understand what the MAX is, it is also important to understand what the MAX is not. The MAX is not, for example, a scalping method. We are not interested to close a trade as fast as possible after just a few pips, 5 to 10 pips, for example, in order to stay as less as possible in the trade. Many traders consider that they will increase their winning rate if they try to stay as less as possible in a trade. But in fact, we have all experienced that fact a scalping system or scalping the market is much more difficult than trading a trend movement, a trending movement. Or at least this is my opinion. The MAX is not a news trading system too. It is very tempting sometimes to try to catch these nice spikes the price makes sometimes in many pairs when we have a news release with a big surprise. And these spikes may be sometimes very important, several dozens of pips or sometimes more than 100 or 200 pips, and so it may be a temptation to trade them. But if you have tried to do them, almost always you have bad price execution if you are still allowed to open your trade. Because we are all also experienced that fact that our trading platform is freezing, and so preventing us to trade, in fact, or we have dimensional spreads having as a consequence a bad price execution. Just to give you a small anecdote, the two extreme situations I have seen for news release in terms of spread, it was on the pound-yen with the non-farm payroll a few years ago. I have seen for some seconds the spread widening to 200 pips, and even one day to 400 pips for just a few seconds. Believe me, when you are in such a trade, when the spread widens to 400 pips or even 200 pips, you are out with a loss, even if your entry and your exit seems to be good, in fact. And as I have said previously, the MAX is not an elementary buy and sell system with fixed, rigid rules. I will explain later in a moment in some example. And so what can you expect from the MAX? And so I'm going to explain the expectations on some chart examples with some recent and past trade example. And this will be also the opportunity for me to explain a little more about the concept of the MAX. As you can see on this chart, it was the Euro-US dollar a few days ago, the 16th of August, so 2 weeks ago, a little less than 2 weeks ago. It was an uptrend on the Euro-US dollar. You can see on the chart several vertical lines. The orange vertical lines represent in this chart respectively the Frankfurt Open, the London Open, and then the US Open. But you see also two red vertical lines. These red vertical lines represent a news release, which may be important or less important. For example, the first one here was the German ZEW on the euro, and the second one was on the US dollar, the CPI month over month. CPI or core CPI. The CPI being the consumer price index, so a direct measure of the inflation. And you know, sorry, and you know that at the moment the inflation is one of the economical data which are followed by the Fed in their thinking process about the possibility to rise their interest rates. And so this is a very important news release. And when these important news releases have a big surprise, it is the moment when we have big movement in the market. And one of our concepts is, because we can never or almost never predict what the nature of the release will be, will there be a surprise or not? If there is a surprise, will it be a positive surprise or a negative surprise? This means that we never trade through a news. And so if we have an open trade, we close the trade half an hour before the news release. And if we are not in a trade, and if a setup appears in the last hour before the news, we simply skip the trade. Okay, and so we wait for the news release in order to catch a potential setup after the news release. Okay, Charles, I'm not sure I can increase the chart. I could do that, but my partners are recording this presentation, and this would screw up the presentation. So, okay, but
Eusebio, you can go ahead and try 95% if you like. Let's see how it looks.
Okay, let's try 95. 95%. Is it a bit better that way?
That's better, and that's fine. Yes, thanks.
Okay. Okay, thanks. So we don't trade through the news. We always close a trade before a news release, or we wait for a news release before considering a trade opportunity. You can see also on the chart that we have some indicators. So we have templates. You applying our indicators. Most of them are standard indicators, and a few of them are custom indicators. But most of the custom indicators are simply the standard ones. We have a little bit tweaked. And so, and by the way, these indicators and templates are available for several charting platforms: MetaTrader, NinjaTrader, TradeStation, Multichart, and Forex Tester. And so we use technical analysis, of course, to define our setups. The technical analysis is one component of our conditions for our setups, but we have also conditions about the risk associated with the trade, and we have also conditions on the global context. The global context being defined with elements like, for example, the news release, what these news release allows us to define as a bias for each currencies, the other external event we have to take into consideration, or situations we have to take into consideration to understand why some pairs are moving in one direction or another. And so we always define an entry setup under three types of conditions: technical conditions, risk conditions, trade risk conditions, and global context conditions. And it is only when all these three types of conditions are fulfilled that we can consider opening a trade. So technical analysis is not enough. It's not enough. We consider, for example, that none of the indicators we are using are predictive. They have no predicting power, but they will help us to pinpoint faster. It's easier to use them when we analyze the price action, because they allow us to go faster in pinpointing interesting situations. And we have two types of interesting situations: when we have an opportunity to open a trade, and when we have an opportunity or the necessity to handle the risk associated with the trade. Okay, that being said, in this example...
I'm sorry, Eusebio.
Yes, Chris, please.
Yeah, Charles is right. The screenshot that you're showing is pretty poor. I can't read the writing here. And I've just compared it to the PDF I created last night, and the quality that you're displaying is quite poor there. So if you enlarge the image itself, it's not going to mess up the recording. It's only if you change the size of the PDF reader itself. So if you can hit the plus button a few times, or...
Let me try to set to 100%. It's the first time we have that problem, so it's a little larger. Is it better for you, Charles?
It's still not very good, Eusebio.
Well, I don't know what to do then.
Okay, next to the 100, you've got those three little icons on the right. Try the one, yep, the middle one, next, just that one. And it's a little better. Oh well, sorry, can't do much about it.
Looks fine now. Looks fine to David. Okay. Well.
Okay, thanks Eusebio, sorry about the interruption.
My pleasure. Every bit help. Okay, Charles. This is much better. Okay. I hope it will be good enough. Well, so now let me explain some of the example of the trade we have. So in this example, we have the price moving upward, and so with the max primer light and the max standard, we will consider only long trades. And so an entry setup, like in this case, is always a set of conditions being fulfilled. And so at this place, all the conditions were fulfilled to open a long trade. And that set of conditions correspond to an entry setup we call a breakout REMO. REMO because it corresponds to a resumption of the underlying uptrend. The uptrend has started way before. Okay? And so after some pullbacks, the trend resumes. In fact, this is why we call it a REMO, resumption with a mo. Whenever we open a trade, we always consider that the trade is made of 2 units. 2 units because at some point we will have to close 1 unit. We keep 1 unit running, and later we will close a second unit. And the size of these units, of course, is calculated with a certain formula we call the position sizing, which takes into account the risk we associate with the trade. For example, is it 1% of our trading account? Is it 2%? Or it is a smaller number? And we take also into account the size of our stop loss. Don't be surprised to see large stop loss. There are reasons why we need to use large stop loss, but it's not because we use a large stop loss that the risk will be larger, precisely because the position sizing takes into account also the stop loss size. And our stop loss is called an emergency stop loss. This is why we name it ESL, emergency stop loss, because its aim is not to protect the trade, but it is to protect our account. In the case we have a technical problem with, for example, our internet connection, the price reverse against the trade, we are blind, and so at least, because the risk is calculated on that emergency stop loss, we risk only that predefined risk at maximum. Of course, along the trend, along the trade, we will adjust our stop loss in order to reduce that risk progressively. And at some point, sometime we will be even able to be risk-free. And so we have rules how to fix the stop loss and how to later adjust the stop loss along the trade. At some point here, in fact, you see an example of a scale out. We call it an MX, a minor exit or a momentum exit. This situation represents an exit rule representing a risk for our position. And we have several types of exit rules. We have exit rules defined with the help of indicators. We have exit rules defined with the help of the price action itself. We have exit rules made of a combination with price action and an indicator. We have exit rules made of the timing consideration. And we have an exit rule based on the movement invalidation. An important point we have in the MAX is we always define the kind of movement we want to trade. And when such a movement makes no longer sense, when such a movement is invalidated, the trade itself is invalidated. So we have a way to define the kind of movement we want to trade and when that movement is invalidated. Okay? And so at one point we recognize a risky situation for the trade, and so we decide to take one action, closing one unit to reduce that risk. And by the way, in this example, we also bank a profit. And then we tighten our stop loss. Banking a profit or reducing the trade size by closing one unit and tightening the stop loss reduces considerably the risk associated to the trade. And later on we have another exit conditions appearing, triggering, and so we close our second unit. Okay? And so here is an example of a first trade. You see two sets of notations, one in yellow, one in white. The yellow represents the entry and exit setup for the max primer, and the white represents the entries and the exit for the max light. And of course, any trade made with the max primer is identical to a trade with the max light, except that with the max light we have more entry setups. So with each upper level of the max, we have more entry setups and more exit setups. Later on here, we have been able to open a new trade corresponding to another set of conditions, which correspond to what we call a re-entry, which is simply a continuation of the trade. And of course, we define its associated stop loss. You can see that the trade is noted only in white. The re-entry is a setup which is available only with the max light, not with the max primer. And similarly as previously, at some point we recognize a potential risk for our trade, we are forced to close one unit, and later on, when we are approaching that important news release, we close the trade, the second unit. And so the second trade, which is here, we will come to the result later. After the news release, we have in this area another opportunity to open a trade, which is the same type of setup than the first one, with the same process, the exit of one unit, and then the second exit just before the second news release. And so in this example, with the max primer, we have been able to make 2 trades, and with the max light, 3 trades. And you see the type of results in terms of pips, respectively 56, 27 pips, and for the max light, 41 pips. And in terms of rework to risk ratio, 1.12 R, 0.45 R, for a total of 1.57 R for the max primer, and an additional 0.59 R for the max light, for a total of a little more than 2 Rs for these 3 trades. And these are typical results for the max primer and the max light. The trade we are making have a result between 0.5 and 0 and 1 R. When we have a winning trade and when we have a losing trade, generally the loss is around minus 0.4 R, and very often less than 0.4 R. And so the expectancy, if you, knowing that we have a 70 to 75% winning rate, if you calculate the expectancy, then you will see that the expectancy is positive. Now, these examples were made with the max primer and the max light, but as I have said, we have also the max standard and the max advanced. Let's see on the next slide the same movement, exactly the same movement, but now handled with the max standard and the max advanced. Again, 2 colors for the notations, yellow for the max standard, white for the max advanced. And with the max standard and advanced, we have been able to enter in that uptrend earlier with another special setup we call a pseudomo. The stop loss is outside of the screen here. This is why I have noted it OOS. OOS means outside of the screen. But just to mention that I have not forgotten to consider the stop loss. And then here you see with the max standard and the max advanced an example of our scaling technique. And so first of all, you see an MX, we close 1 unit. And then at some point here, we have an SC1, scaling number 1. And so at this point, which corresponds to an entry, a set of entry conditions, we add to our trade. And whenever we add to our trade, we add 2 units. The size of these 2 units is the same as our initial trade. And then later on, we make another MX, so we close another units. By the way, you can see that here, the MX has been made only for the max standard, not for the max advanced. We have special rules, we have additional rules with the max advanced, allowing us to improve our result most of the time. And then so we have another MX here, followed by another scaling, followed again by an MX, followed by a scaling. So whenever we make an MX, we close 1 unit. Whenever we make our scaling, we add 2 units. And so at this point, when we make the scaling number 3, we have 5 open units with the max standard and 6 open units with the max advanced. And so, and we continue. We make an MX, we make another MX in front of the news. This is a news when we better understand the news, we can stay in the trade. This happens sometimes. Then we have another scale-in, another MX, another scale-in, another MX, and then the final XXX in front of the main news about the USD CPI, Consumer Price Index. And so you can see one unique trade with several entries or scale-in, several exit or scale-out or MX, and then a final close here. And when we calculate the result of that kind of trade, we can see that with the max standard we have got a total number of 389 pips, representing plus 7.78 R, almost 7 3/4 R. If you take a risk of 1%, this means that on this trade you have made a profit of 7.78%. If you take a risk of 2%, this means that you have made a profit of 15% on your account. With the max advanced, because we have been able to avoid an unnecessary MX on this point with a more advanced concept, and another one here, so we have avoided 2 MX. And sometimes we will be able to make an additional or several additional scale-ins. It was not the case here. But this means that with less MX and more scale-ins, we generally increase the result of the trade. And it was the case here. We have increased the result by approximately 26%, making 494 pips instead of 389 for a reward to risk ratio just a little below 10 hours, 9.88 hours. So almost 1/4, 25%, 26% more than the max standard. And when you compare these numbers with the numbers of the max primer and the max light, you can see how the scale-in and scale-out process increases the profit. But of course, as I have said, doing that, we need to have a strict control on the risk on the trade. Okay? And what you will learn into the max standard when the scaling process is taught is the most risky portion of the trade is at the beginning. Later on, when we have enough profit under our belt, it happens at some point, because of the MX and the stop loss adjustment, that whatever the number of scale-ins we are able to do, we are in a risk-free situation, and the only consequence we will have with more scale-ins and more MX will be an increase of the profit. But it will be extremely rare to be again in a dangerous situation with, or in a potential losing situation with our trade. This may happen if we have a black swan, for example, if we have the price suddenly reversing against the trade very fast. We cannot always avoid all the losing situations, unfortunately. So this was the first example showing the differences between the different levels of the max. I will talk a little more about the EMAs after this presentation later today, because there is something to tell about the indicators we are using. Another example on the pound yen, on the cross. Similarly, it was in May, a few weeks ago, before the US Open. Again, a setup corresponding to a REMO, followed with an MX and then an XXX, because we had 2 successive exit conditions, and then a re-entry trade with, again, an MX and then an XXX. And so 2 trades with the max light, 1 trade with the max primer, and you see the type of reward to risk ratio we are able to obtain. On this chart, you are seeing something else. You are seeing that red magic box. Sorry, that red box. And our students have called it the red magic box. In some circumstances, it is possible to predict when it is a time window, not a price level, it is a time window, when such a movement will exhaust. And you can see here that, in fact, the price has exhausted, the high of the day was in this area, right in the middle of our red box. And so there are some circumstances when it is possible to make such a prediction, which is a great help to close the trade. In fact, if we can have a good idea when a trend will exhaust, we can make better exit. And by the way, these situations, when the price exhausted or the movement exhausts in that time area, happens in 75% of the case when we have the appropriate movement I call a true trend. Now, the same movement, we had 1 or 2 trades depending on the level of the max, the basic level of the max, but the same movement with the max advanced and the max standard gives something completely different. With the max standard, we have one scale-in here, we have another scale-in here, we have a third scale-in here, a fourth scale-in here. You see all the MX, MX1 here, MX2, MX3, MX4, MX5, MX6, and then our final exit, which corresponds to a normal exit condition, but inside our red box. And so this is a good place to close the trade. We are not looking to catch the highest high of the day, but as long as we are in the conditions we know we have 75% probability for the trend to exhaust, then we have a good place to exit. And you can see the result around almost 600 pips for a reward to risk ratio of 7 and almost half. With the max advanced, what do we do here? We have been able to make an additional scaling here. That additional scaling allowed to increase the profit by more than 100 pips, going from a reward to risk ratio of 7 and almost 5 to 9.2 hours. So a nice increase in the result. And again, you can compare these results to the result made with the max primer or the max standard. Okay, and as I say in that slide, don't try to make scale-ins and scale-out in order to increase your profit if you don't have the rules to control the risk. Okay, controlling the risk is essential. It's very attractive to be able to make such kind of trade when we have such nice movement, which happens on average for each pair 2 or 3 times per week, which is largely enough to get these nice results. Now I say on average, this means that sometimes we'll have less such movement and sometimes we'll have more of these movements. So this slide shows the max standard and the max advance, how the entries and the exits are distributed along the trade. But as you know, I have mentioned a 5th level of the max, which is called the max ETF. And we have 2 versions of the max ETF and the max sum ETF. I'm showing here the max ETF. The max ETF generalizes the concept of movement we are trading with the max. With the max, up to the max standard, we trade the trends. So the movement, for example, long movement when the price moves above our home base, that blue aqua moving average, which is a long-term moving average, is called the home base. And when the price is above, we look for long trades. When the price is below, we look for short trades most of the time. With the max advanced, a movement above the home base but toward the home base is a counter-trend movement. But with the max ETF, we generalize all the movement, trend and counter-trend movement, into directional movement in such a way that we are able to trade in both directions. And this is an example. The previous movement we have traded with the max primer, light, standard and advanced. With the max ETF, the advantage of the max ETF is we are able most of the time to open the trade earlier in the trend. Instead of opening the trade in this area, we have opened the trade in this area a few pips before, sometimes 10 to 15 pips earlier. And believe me, 10 to 15 pips in the 5-minute time frame does not seem to be an important number. But because we keep the 2 units of that entry as long as possible along the trend until the final X66, that earlier entry makes a big difference. And so we may have additional entries and exit for our scale in and scale out. So you see all the decisions here in this example with a REMO entry, its stop loss, which is generally smaller. So we get generally higher reward to risk ratio. So one scale in here, an MX, a scale in, an MX, a scale in, an MX, scale in, MX, scale in, MX, scale in, MX, exit. Okay, right inside the red magic box. And so you can see the type of result. And so with the max ETF, because we are able most of the time to open the trade a little bit earlier, the increase in the reward to risk ratio is amazing. If we compare that with the max standard 7.4, we almost multiply the reward to risk ratio by 3, by 2 when we compare it to the max advanced, simply because we are able to make an earlier entry. Because the size of our scale-in is always the same, when we have to make an MX, we can close any open units. The order of the units we have to close is irrelevant. When we make our XXX, we will always obtain the same result, whatever the order of closing the units. And this is why when we open a trade earlier, this is equivalent to consider that these two units are closed, in fact, at the final XXX. And this is why its contribution is very important. Now, in terms of trade risk management, it is always better when we have to close one unit to close the oldest unit. Most of the time, it will be the most profitable one, and then for those who have to comply to the FIFO rule, it's FIFO rule compliant. Okay? Well, so this shows that we are mainly with the max trend followers, or directional movement follower, as I prefer to say. Okay? Well, the example I have shown were paired on the 5-minute time frame, but we can trade any other instrument on any other time frame. An example here was the silver contract, a commodity, in the 4-hour time frame. I could have taken the gold, for example, or the crude oil, or an index like the ES, so the Standard & Poor's, the Dow Jones, the Russell, the DAX. I have a lot traded the DAX in the past. It is really fun to trade the DAX, by the way. So the silver 4-hour time frame, you see exactly the same type of structure in the price movement. And so it will not be a surprise to see the same type of decision in the trade. We have an entry, we have possibly a scale-in, a scale-out, so a series of scale-in and scale-out until we have a final close. Sorry. And so you can see the type of result we get with the max standard and with the max advance. It was not a big movement. This is why the reward to risk ratio seems to be a small one, but the stop loss was also a rather large one. So any time frame, any instrument. This is an example of the Euro USD in the daily time frame with the max ETF. And so again, the same kind of structure in the trade steps, one entry, and several scale-ins and MX along the trade until we get our final exit, which is an example of a movement invalidation here. Okay? And you see the type of result. This was an exceptional trade, but it is in the daily time frame. And so don't be impressed by the number of pips. When you trade on the daily time frame, it's easy to make several thousands of pips in a nice movement, downward or upward. And by the way, myself, I have traded such movement in the Euro USD, which has lasted 1.5 years almost. And so, but you have an idea of the kind of reward to risk ratio we can obtain and in which time period. I have said that we have, with the max, 75% winning rate. This does not mean we have 25% losing rate. We have around 15% of our trades which are losing trades and around 10% which are break-even trades. The power of the max is whenever we have a losing trade, the loss will be always small. And this is a typical losing trade. And let me explain the structure of the trade here. The price is moving above our home base, so we are looking for a long trade. At some point here, we have a REMO setup. It was a past slide. This is why I have kept my old notations by 2 units. So it was a REMO with 2 units to open. And immediately after that, this is something everyone has faced, the price reverses. And after a few bars, we had a condition to close 1 unit. So here we close 1 unit with a loss. So the unit which is closed with a loss. But this also helps to reduce the risk on the remaining position. And later on, the price, instead of resuming the uptrend, continue to go downward, so continue to go against the trade. And then we have a rule which has triggered here telling us to close the second open unit, also with a loss. Remember, I have said that our emergency stop loss is there to protect the account in the case we are no longer able to make a decision, to implement a decision. Our aim is, when we are able to decide and to act, to never let the price hit the stop loss. This is an example with the price going against us when we scratch the trade before the price reaches the stop loss. Of course, you could tell to me, yes, okay, but later the price has never touched the stop loss, and the trend has resumed. Yes, but in real time, when you see the price going against you, you never know in advance how far the price will go against you. So you need to have rules to tell you when to close your trade. But despite it was a losing trade, and the number of pips closed with the 2 unit were minus 41 pips, this represents only minus 0.44 hours, or minus 0.44 to 1. So a small loss, which can be easily recovered with just one winning trade, as you have seen with previous example. Of course, on average, you will never have, when you use the scaling technique, trade with 4, 5, 6 scalings. Usually you will have 1, 2, 3 scalings. But even with 2 or 3 scalings, the reward to risk ratio will be very often larger than 3 to 1, 3 hours. And so with a 3 to 5 hours winning trade, you can recover many losing trades, many losing trades. When we use our indicators on the chart, like in this example here, in fact, an important concept of the MAX is to be able to recognize the market conditions. And in the MAX, we define different price modes. Each price mode represents a market conditions. And so we have several price modes. We have a trend mode. We have a counter trend mode. We define also what is a consolidation zone mode, in which case we'll have to make a distinction between a tight or a small consolidation zone and a large one, because the way to handle a setup in these two types of concession zone is completely different. In one case, we can open the trade inside the concession zone. In another case, we'll have to wait for its breakout. So we will have to define its support or its resistance level. And then we have another mode, which is a complex mode to recognize, which is the choppy mode. This is an example of a choppy market. The price has no clear bias. It makes fast push in one direction, immediately reversing in the opposite direction, and so very erratic behavior in the price movement. And so we call that a choppy mode. The trend, counter trend, and concession zone mode can be easily recognized very quickly. Very often 1 or 2 bars are enough to recognize when such a mode starts. With the choppy mode, we need many more bars. And so you can have the impression that recognizing the choppy mode, because it takes more candle to recognize, make it more difficult to trade. Fortunately, and this is the reliability we have with the MAX, it's extremely rare to have a valid setup, entry setup, while we are in a choppy mode. It may happen. From time to time, we may have a valid entry setup. But when we have such a valid entry setup, we have the choice to skip that trade because it's a rare circumstance, or we can decide to trade that setup, but then we have a special way to handle the trade in a choppy mode. We have to take into account that the price can reverse very quickly. And if we observe special rules, dedicated rules to handle a trade in a choppy mode, chances are high that we will be able to close the trade with a profit, generally a small profit, but still a profit. We can choose, as I have said, to skip the trade, but the problem is we never know when the price will leave the choppy mode. And when the price leaves the choppy mode, it will enter usually a trend mode. And so this is why it may be interesting to trade a choppy mode, because we still have the possibility to participate to a trend when the price leaves the choppy mode. Okay? But the setups in a choppy mode are rare. Okay? And this is by the way we define our technical conditions. But remember, the technical conditions are not alone. We have also risk conditions and global context conditions. And a variant of the choppy mode is a nice situation we call a spaghetti zone, when we have choppy conditions, but in a very tight range. And in such spaghetti zone, we have the guarantee to have never a valid setup. We have always to wait for the price to break that area. This is why we need patience and discipline. Well, let me talk a little bit about the money management we have. When everything goes nice with the market and we realize our average winning rate and to risk ratio, we can compound our profit. By the way, when we have less favorable conditions, we can also uncompound. And with the problem of controlling the drawdown we have, let me tell you that in the Max Advanced course, I teach a technique which allows to completely control the drawdown. We can predefine a maximum drawdown, let's say, for example, 20%, and if we apply the technique I teach in the Max Advanced course, we are guaranteed to never have a larger drawdown than 20%. And this is really a very safe way to trade with the Max. So, but when we are in favorable market conditions, we can compound our result, progressively increasing the trade size with the account growing. And let me show you how an account can grow rather fast, even if we make small results. And this will show that what is important is not necessarily the nature of the result we get, but the consistency we obtain applying the rules of the Max. The consistency must never be searched in the result we want to have, because we cannot control the result of a trade. We cannot control the market. We never know in advance how far the price will move in favor of the trade or against the trade. But what we can control is the discipline with which we apply our trading process. And this is where the consistency must be achieved. Now, let's make some strong assumptions here, just to give an idea of how an account can grow. Now, don't consider this is the mirror of the reality. There are some difficulties I will explain. Let's suppose we start with a trading account of $10,000, let's say $10,000, and we use a 2% risk per trade. And let's suppose to make some future projection that in the 5-minute time frame, our average size for the stop loss is 30 pips, which is approximately the case. And let's suppose that we are able to make on average 60 pips profit in 1 or in 7 trades. We are not forced to make that result for every trade. With the example I have shown to you previously, which are normal to good trades, it's not so difficult to achieve such a result. But let's be conservative. And so 60 pips, which represent a 1 hour reward to risk ratio. Indeed, remember, each trade is made of 2 units. So when we get a total number of 60 pips, the average result is obtained by dividing the total number of pips by 2, 30 pips. And if we divide 30 by the size of the stop loss, 30, we get a 1-to-1 reward to risk ratio. Okay? And so let's see what we will obtain as an account growth if we make no withdrawal. After 1 month, if we trade every day, which is a strong assumption here, after one month here, we can see that the account has grown to $15,000. We have increased the account by 50%. And because we can project some result, our objective is, for example, to double our account. We have as a projection that we need almost 2 months, 2 trading months, to double our account. And indeed, after 36 days, the account has jumped to $20,000 without any withdrawing. Okay. Now, of course, I have said this is a strong assumption because it's not sure that we can trade every day. Personally, I trade on average 2 to 3 days per week. Sometimes a little less, sometimes a little more, depending also on what is happening in the market. But this is a quick idea of what can be obtained with a rather conservative result. If we take a situation a little more ambitious, for example, instead of making 60 pips on average per day in 1 or several trades, let's suppose we are able to make 100 pips. So not the double, but a little more than 60 pips. And our objective is to multiply our account by 10, which is very ambitious. and furthermore, we withdraw every month. 1 month has an average number of days of 21 trading days, and we withdraw 5% of the account every month. 5% of the account, not 5% of the profit, 5% of the account. We can see that on the second month here, we withdraw $1,882. The total withdrawn with the 2 first months is just a little smaller than 3,000, but the account has been multiplied by 3.5. And on the third month, we are able to withdraw $3,560. The total withdrawn is more than $6,000, and the account has been multiplied by 6.7. And we will need, in fact, 75 days to achieve our financial objective of $1,000 with the withdrawing. Okay, but again, so this shows that even with a rather conservative result, we can, if we can apply our trading process in a consistent way, we can grow an account rather quickly. But of course, remember, I have said that trading every day in a small time frame is a big assumption. This means that in reality, it will be necessary to have a little more days. And by the way, there will be days when we will make a better result. There will be days when we will make a smaller result. There will be days when we will make a loss. And so because of that more realistic distributions of profit and losses, you will need a little more days to obtain your objective. But it is not impossible to achieve it. What is key here is to achieve the consistency in the way to apply the max. Okay? And of course, in an unfavorable period, we uncompound. This means that we still apply a 2% risk, but on a trading account which is smaller. For example, if you have a drawdown of $1,000, your remaining capital is $9,000, you will apply a 2% risk on $9,000. So this is uncompounding in such a way that you will reduce your trade size in a drawdown. Well, so the max is organized in 5 levels, in 5 course levels. Chris will speak a little more about that with more detail. The max primer, the max light, the max standard, the max advanced, and the max SAM ETF. Each one being an upper level than the previous ones. And you see where there is some prerequisite. Most of them does not require prerequisite. For example, the max primer and the max standard does not require prerequisite, but the other obviously require prerequisite. And so with the max, in fact, whatever the level of the max you want to study and to apply, you will have a trading methodology which is based on strong and sound concept. I say strong and sound concept because during the courses we also explain why these concepts work in relationship with the behavior of the big boys in the market. For example, do you know that some types of pullbacks are a footprint of the big boys? And so it is interesting to know which pullbacks are the footprint or one of the footprints of the big boys. And so this is why I say we have an explanation why this concept works in relationship with the big boys behavior. Furthermore, with the max, we set the focus on some important aspects. So we want to reinforce some important aspects. We do not trade indicators. We use indicators, of course, but we do not trade indicators. As I have mentioned, they are there simply to help us going faster to pinpoint potential interesting situations. And by interesting situations, I mean an entry setup and an exit setup. And we have, with the max, a very strong, solid, firm method with a sound risk and money management aspect. And so this means that the first priority we always have when we have a trade, an open trade, is the risk monitoring, never the profit we can get from one trade. This means also that when we are in a trade and at some point the price retraces and we are seeing a large portion of our profit evaporating, we have to stay in the trade as long as the trade is not invalidated. As long as the trade is still valid, whatever happens, we have to stay in the trade. And so we attach a lot of importance furthermore in the personal confidence development. We want our traders to become confident in themselves, and this is achieved, or we try to achieve that through coaching. Our practice session each Saturday is a form of coaching. We attach a lot of importance in the homework. The homework is not an obligation we ask to our student to convince ourselves that they have understood the rules, but it is a validation tool for themselves. It is important for themselves to realize that they are applying the rules correctly. And so the homework is such a validation tool. And so the practice, we show in our courses, we show during our practice session how to practice in a demo mode with a strategy tester or with past static charts. And then later on, our students can participate in our forum, which exists and which is fully accessible by our members. They can have an active participation in our scrolling parties, and they can participate in some of the workshops we organize live along the year. When we show live how we apply the rules of the MAX with the uncertainty about the future, because when we are live, we don't know how the future will be, what the future will be. And so this shows that we are forced to apply the rules we teach in our courses. And so later today, when Chris will make his presentation, I would like to go a little deeper into specific subjects about the MAX you will be able to use in your present trading system if you are interested. But in the meantime, I would like to thank you for your attention, and I give the mic to Chris. Chris, up to you.
Okay, thanks Eusebio. Can you hear me okay?
Yes.
Cool. So if you can act as my lovely assistant and change when I go ding, that'd be great. So next page, please, Eusebio. Thanks. Hi everybody, I'm Chris, I'm based in New Zealand, and I'm a partner and also a trainer in the MAX trading system. This is our 50th set of MAX courses, so it's kind of a milestone for us here at the moment. We've had something like 1,500 to 1,700 members in our that have gone through the one form or another of the MAX. So we're been around a while, since 2007, 2008 when Jim started. Okay, here is an example of a table of some course comparisons. The first two columns labeled primer and standard, and these are the courses that we've got that we're promoting today. The other ones come later. So the primer is a subset of the standard. So the standard is our flagship and has got 7 entries. The primer is just a cut down version with only 2 entries in it. Oh, sorry, 2 weeks, 2 entries. And the primer is there just to give people, if somebody wants to say, you know, I don't know about these guys, let's try them out. So the primer is there just to give you a taste of what things are like with the MAX. The standard is the one to go for because it's got all the profit acceleration, the ability to increase your profit remarkably using scale-ins, and the enhanced money management side of things. Okay, so the primer is still profitable. It just means because you've only got 2 entries there, that if you're waiting for an entry on a pair, then the standard could have another 5 entries go past before you see another entry in the primer. So with the primer, you could be sitting around waiting for quite some time. It's much slower than the standard. Moving up further, once you've done the standard, then you can do things like advanced or SAM and ETF courses, and they've got even more entries and more profitability as well. So it all builds on from the standard. The standard has got a lot of exit techniques, a lot of entry techniques, as well as the scale-ins, and so once you've learned the standard, then all that information flows through to the more advanced courses. Each one of the courses you'll be asked to do homework. It's not compulsory, but highly recommended. And you'll also be invited to the practice sessions that Eusebio was talking about, our scrolling parties. We also have a forum, so whenever you've done one of the courses, you'll be invited to that level of the forum. If you have any charts or questions or want any indicators or something like that, then they're all available on the forums. And speaking of the forum, once you've finished the course, like we do our training, can I have the next slide please, Eusebio? Might as well do that. Yep. The middle section says that we train with the MetaTrader platform, and this is because there's no fees, the data feed is free, there's minimal setup, we supply you with all the templates and all the indicators so you don't need to mess around with it. Put together some little training videos so you get used to the MetaTrader platform if you haven't used it. But if you want to use something later like Ninja or TradeStation or multi-charts, what else do we have? I think that's about it. Some of our members have converted the MetaTrader indicators to those platforms and have given them back to us to give to our members. So they're all available, there's no charge for that. And if you want to convert them to another platform, I can supply you with the source code from the MetaTrader as well, no charges. So we want to make you, let you use whatever you like, and we don't have any sort of anything really proprietary. There are a couple of indicators later, but we will explain what they are, which we've developed, which we do charge for, but they're not essential to the training itself. Okay. The courses themselves are very detailed and very precise. So when you're actually trading, what we do is you find the setup candle, and then on the next bar it could be within 2 to 4 pips. And these days, because volatility is so low, within a half a pip of you finding your setup bar, that you actually get to enter or exit on the next bar. So and this is presuming you're using a 5-minute chart. So it's very precise. We provide all the course materials. So once the session is finished, you get the video within about 24 hours. All the PDFs, notes, examples, etc. will be sent to you via the homework group for you to pick up, including any indicators and expert advisors that are needed. So everything's there. You don't need to do that much. Next slide, please, Eusebio. Okay, so pricing. The max standard itself, with all the profit acceleration and the money management, etc., starts on September the 7th, runs for 7 weeks. Eusebio will be taking the next standard course. Normally I do them, but I want to concentrate on my trading. And so I'm stepping back from the training, and Eusebio wants to do this. So he's going to be teaching the standard course this coming 2 months. The normal price is just under 3,000. We've got a webinar special for 2,399. And as I said before, if you want to take all 3 courses, the primer, the light, and the standard, which will give you something like 4 months worth of training, Craig has put the pricing together for 2,679. So really good deal. It would really hammer things in for you, so long as you did all the homework. And there is a lot of work. I have to say that trading the Forex is hard work. A lot of people think I get a couple of indicators, wait for them to cross, get some sort of bell going off so that I know when to enter, and I'm away. It doesn't work like that. There is a huge amount of information and behind the scenes that you need to take care of. And like Eusebio said in his presentation, the max standard has got a lot of it built in natively, implicitly, and as more information comes to the surface these days, because the Forex training and learning and environment is still unfolding, we can incorporate more and more of that into the standard itself, or into our courses, so that you get a better, more in-depth understanding of what's going on in the markets themselves, like what the big boys are doing. And Eusebio will give a bit of an explanation of that, and then once we've done the giveaway. Okay, so if you're interested in this, hope you are, then the link is there at the bottom, and Craig will be sending out emails with the links, and so you can take advantage of this. And Thanks. And the Max Primer. So if you're not too sure about us, and if you're not, have a look at Forex Peace Army. We can send a link out for it so that you can get some reviews of what we're like. We've got something like 65 people have said stuff about us there. The Max Primer will give you just a taste of what the Max training itself is like. It's only a couple of sessions, only a couple of entries. Like I said, it's basic. It is profitable, but it's much slower than the standard course. And then when you get up to ETF, that really clips along, because you'll be taking trend and counter trend entries going in both directions, pretty much in the market all the time. But the primer is very slow, so you'll require a lot of patience to do it. The course dates are September the 12th and the 19th, so it starts a week after the standard course. The normal price is $329. We've got a special going this based on this webinar of $159, and Craig has done another package there. So if you want to take those, you're most welcome. Just let us know, and if you have any questions, please email in or Skype us as well. We've got all our details. They'll be coming up shortly, and they'll be in the emails that you get from us too. Next slide, please, Eusebio.
But just a small word of caution. I don't know if you hear through my headset. A storm has started here. My blinds are closed, and you probably hear the rain against my blinds. So I may disappear at any moment. So because of this storm.
Okay.
I'm going to show you two small tips you can use immediately in any trading system, provided your trading system is mainly a trend following system. The first one I will show on the PDF, because it is really easy to understand. And let's come back to an example here. I will take the primer version. There is not a problem. Not this one. Let's see. Yeah, this one. And I will take the primer version here. When you are in a trade, either a long trade or a short trade, from time to time, for any reason, you will see a candle like this one. We call that type of candle a long bar. And a long bar must have a condition on its size. Generally, when you compare its length from the low to the high, or from the high to the low, so wicks included, and when you compare its length to the average length of the candles from the previous movement, so the candles here, generally, if its size is twice or more the average length, it will be considered as a long bar. And when we have such a long bar, of course, the price can continue to move upward. But what happens very frequently is, after a long bar, we will have a retracement. Let's see if we have such a retracement on a previous example. You see here we have another long bar, and then we have a retracement here. And sometimes the retracement can be a deep one. Very often it will be a retracement erasing completely the movement made by the long bar. And so in order to reduce considerably the risk we have on a trade, whenever we have a long bar, we always consider a long bar as a gift of the market, because it is a fast profit when it is in the direction of the trade. And we use that long bar after it closes as a potential way to bank some profit. You see the example here. So we have a long bar. We had the first long bar here, but no profit to be taken. And then the second one, which was also a long bar, and then we take a profit. How do we take a profit? Because it is a long bar, the profit will be always a nice profit. And so because we expect the price to retrace, the question is, how much do we accept for the price to retrace before we bank a profit? And so it's up to each trader to decide the size of the bar the price can retrace. It can be, for example, 20% or 25% of the length of the bar. It may be 1/3 of the length of the bar. It may be half of the length of the bar. For example, if the bar is made of 30 pips, we can make a profit if the price retraces 1/3 or 10 pips, for example. It was the case here. The price has retraced from this high 1/3, a distance equivalent to 1/3 of the length of the bar. I have marked an MX here. And so I don't advise to get or to use a small retracement, because sometimes the price will make a very small retracement before resuming. You see here, the price has made on the next candle a first retracement, but a small one, and then the price has resumed to the upside. So we need to take a retracement large enough to avoid such kind of situation. So 1/4, 1/3, or half of the size of the bar are nice ratios. And of course, from time to time, the price will continue. For example, here we have another long bar and the price continue. And so helping us to get more profit when we have another exit conditions. So the long bar is always a nice opportunity to bank a profit, and you can use such a technique in any of your trading system. Either it is a trend following system or even a scalping technique. If you get a scalping, if you use a scalping technique and then suddenly after your entry you have a long bar, you can also, of course, use that long bar as a way to scale out, for example. You don't need necessarily to close the entire trade, but you can scale out, so close a portion of your trade. So this is the first tip I wanted to show you today, and you can use immediately in any trading system. The second tip is the following. Let me show, for example, the euro-US dollar here. For those of you who were in our workshop last week, open house last week, you recognize the template I'm using. This is the template of the Max Primer and the Max Light, except for these small red and green diamond, which are used with the Max Standard. So I will not explain their role today. You can see that we use several moving averages. A gold one, a blue one, a red one, and an aqua one. The gold one is called the momentum line, and it is the closest to the price action itself. And so the direction of that moving average gives us, most of the time, the direction of the price itself. When the price is going downward, the more line is going downward. When the price is going upward, the more line is going upward, and very close to the price itself. And we have longer time frame moving averages. The blue and the red one we call balance lines, the blue balance line and the red balance line. And we have our long-term moving average we call the home base. And it's the home base which decide the direction of the trade we take when we use the Max Primer, the Max Light, or the Max Standard level. You can see that our moving average have a shift too. So it is often said that a moving average or technical indicator have lag. It's true, they are lagging the price, and we add more lag to them by adding a shift of 3 to our more line, 5 to our blue balance line, 8 to our red balance line. Because in fact, what is important to understand, it's not the indicator itself which is important, but it is the relationship between the global behavior of the price with the global behavior of the moving average, which is important. The fact that the indicator is lagging and we may possibly add to the lag is not important at all. Okay, it's simply a nice and simple visual way to see if the price is trending. Another question which is often asked is when you have a setup, do you check higher time frames? And in fact, we explained that it is not necessary, because our EMAs, in fact, are designed in such a way to represent what is happening in these higher time frames. The blue balance line, in fact, represent in reality on our templates through its settings what the more line is doing in a time frame 3 times higher. Let me show you that. Let me draw here on this portion of the blue balance line, that way, a straight line, white line. And because I'm trading here, I'm not trading, but because I'm showing the 5-minute time frame, let's switch to a time frame 3 times higher. This means in this case 15 minutes. Okay? And what will we see? We see that the white line I have drawn previously on the blue balance line is now almost on the more line of the 15-minute time frame. And if not exactly on the more line, parallel to the more line. What does this mean? This means that in the 5-minute time frame, the blue balance line represents the more line of the time frame 3 times higher. And so if I come back to the traded time frame, what does this mean? It means that we have not only the more line pointing downward, but we have also the more line in a time frame 3 times higher also pointing downward. Okay? So we have with our blue balance line what is happening in a higher time frame. And so we don't need to switch to that higher time frame. Now let's make the same exercise with the red balance line. That way. And let's switch now to a time frame, to the 30-minute time frame. So 6 times higher. And what do we see? We see that the white line now, which was on the red balance line in the 5-minute time frame, is now again sometimes on the more line or parallel to the more line on the 30-minute time frame. This means that in the 5-minute time frame, here, the red balance line represents in fact the behavior of the more line in a time frame 6 times higher. And so again, we don't need to switch to that higher time frame to check what the price is doing. We know that with the blue balance line and the red balance line, that the price and the more line essentially is also going downward in these 2 higher time frames. And let's do that again with the home base. Let's do that, for example. Let's draw a straight line on average along the more line, the home base. And the home base represents, in fact, our more line in a time frames 12 times higher. So 12 times higher than the 5-minute time frame is the 1 hour. Let's switch to the 1 hour. And again, you see here that the more line is parallel to the white line I have drawn previously. Sometimes it will be right on the more line, and sometimes it will be parallel, exactly parallel. Okay? So this shows again, then in the time frame we are trading, the home base represent the more line in a higher time frame, 12 times higher. And so with these 3 moving averages, the blue balance line, the red balance line, and the home base, we have also a multi-time frame vision of what is happening in the price action. And this is why we attach a lot of importance to the angle of these moving averages. We want to have the more line pointing downward. We want to have the blue balance line pointing downward. We want to have the red balance line pointing downward. And if we have also the home base pointing down, it will be a bonus. It's not an obligation, but it will be a bonus. And so one of the most important concept we want to see with our EMAs is the concept of angle. If they are pointing in the direction of the trend we are looking for, and we want to trade, then we have that multi-time frame confirmation that the trend is also in the same direction. And of course, when we are looking for example, we have in this area a nice breakout re-entry setup to catch that last portion of the trend that day, Friday, after Yellen speech here, Yellen lecture. We are guaranteed when we look at all our EMAs that we have several higher time frames where the momentum is also pointing downward, which add to the safety of the movement. Okay? But as soon as the more line, for example, has no longer the direction we want, or the blue balance line, or the red balance line, or the home base, then we know that we are no longer in a context to look for a short trade here. And similarly, when we are in an uptrend. We have other conditions, of course, on our EMA, but the tip I wanted to show you here is we don't need to switch to higher time frame or to display several charts with higher time frames to check what is happening. Simply exploiting the mathematical relationship between the price and the moving averages is enough to check these higher time frames. This means that we can also monitor more pairs. And so you can monitor potential more possibilities, opportunities to trade. Okay? Is this clear about that concept?
Eusebio, could be
Yes,
that you've been a bit coy about calling them yellow, blue, and red. Approximately what sizes are the moving averages that you've got there?
Yeah, there are very classical settings. The MoLine has a setting of 21 period, and this is a setting which is very often used by professional traders, 20 or 21. The blue balance line corresponds to the 50 moving average. The red balance line corresponds to the 100 moving average. We have settings which are a little different, but the difference is not significant. And the home base corresponds to the 200 moving average. Okay, so really classical period. So 2021, 50, 100, and 200s.
Okay. Well, if you have any questions, please email us. The courses start not next week, but the week after. You've got the links for the course, the webinar pricing, and Craig will be sending out emails with the links as well coming up shortly too. So thanks, Carol. Nice. So thank you, everybody. Have a good Saturday or Sunday, wherever it is in the world.
Have a great rest of the weekend and see you later. Bye, everyone.